This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hello everyone, welcome back to my channel. Looking back at 2025, the global market indeed experienced a structural tech bull market, driven primarily by AI infrastructure as its core engine. As 2026 officially begins, I'm curious to see how your tech sector covered call ETFs performed over the past year. In today's video, we will conduct an analysis of 5 of the most popular tech-focused covered call ETFs currently listed in Canada: ZWT, JEPQ, QQCL, QQQY, and HTAE. I will examine their underlying logic, the actual quality of their distributions, and their performance data to help you clarify which ones are genuine cash flow machines and which are truly worth holding. As many of you may know, QQCL makes up a significant portion of my portfolio. However, since QQCL does not yet have a full year of performance history, it has been excluded from this video for the time being. So let's begin today's video. Now, let's dive into my overall thoughts of ZWT. First, it is important to understand that ZWT is not a passive index tracking fund. It is an actively managed portfolio. Launched in January 2021, it has the longest track record among the ETFs we are discussing today. Currently, it offers a yield of 4.86%. In 2025, with distributions reinvested, it delivered a total return of 17.94%, outperforming the NASDAQ ETF's 15.38%. Its holdings consist of 30 top-tier tech giants, including familiar names like NVIDIA, Microsoft, Apple, and Broadcom. In terms of cost, ZWT has an MER of 0.71%. Given that it uses no leverage, this fee is quite reasonable within its category. ZWT is unhedged. As this isn't explicitly stated on the fact sheet, in this industry, the absence of a hedging clause means it is unhedged. This is exactly why, over the past few years, holding ZWT has allowed us to profit from both the growth of tech stocks and the appreciation of the US dollar. Regarding its covered call strategy, BMO's website states they cover 50% of the portfolio by selling out-of-the-money calls. However, given the current 4.86% yield, my guess is that the strike prices are being set very far out of the money. As I check the covered call report from BMO, I have confirmed my guess. But this is precisely ZWT's core advantage. It leaves substantial room for price appreciation. Its net asset value has climbed from roughly $30 at inception to about $60 today, effectively doubling the share price. Most impressively, as shown in this performance chart, its total return since inception in January 2021 reached 141.37%, with distributions reinvested, significantly outpacing the NASDAQ ETF QQC at 113.68%. ZWT has actually managed to beat the pure NASDAQ 100 index over this period. This success is a result of its concentrated exposure to pure tech and its relatively conservative covered call approach. Based on these data points, I have a very clear view. You can fully spend the distributions from ZWT without needing to set up a dividend reinvestment plan. Why do I say this? Let's look at the actual figures. Since inception, the monthly distribution has increased from 13 cents per share to $0.245 today, a nearly 90% increase. Inflation over the same period has not come close to that level. This means the distribution is dynamically adjusted upward as the NAV grows. Every share of ZWT you own is becoming a more powerful cash flow generator at a rate that far outpaces inflation. When buying covered call funds, we often worry that our purchasing power will shrink if we don't reinvest. ZWT proves that if the underlying assets are strong enough, the fund can provide monthly cash flow while ensuring your capital is self-evolving. In a non-registered account, ZWT's distributions typically consist of capital gains and return of capital, making it more tax-efficient than earning interest. Holding this fund provides a genuine sense of passive income. You don't need to increase your share count to combat inflation because the value per share and the distribution per share are doing that work for you. If you believe in the long-term tech thesis and need cash for bills or daily expenses, you can spend this money with total peace of mind. Next, we have to talk about one of the most popular names in this space, which is JEPQ from JP Morgan. In the past, we had to go through the hassle of converting currency to buy the US version. But the good news is that JP Morgan has launched a Canadian version on the Toronto Stock Exchange under the ticker JEPQ. This makes it incredibly simple to add this Wall Street income generator to your Canadian accounts. Its full name is the JP Morgan Nasdaq Equity Premium Income Active ETF. It trades in Canadian dollars, and its current yield is sitting around 10%. This is a very balanced figure, higher than ZWT but lower than QQQY. The management fee is the same as the US version at 0.35%, with a total MER of approximately 0.4%, and it is explicitly unhedged. Its core strategy is active management. Instead of strictly tracking an index, JEPQ relies on a professional team at JP Morgan to handpick stocks while generating income by selling out-of-the-money call options. In theory, JEPQ isn't chasing extreme growth. It's looking for high-quality income. By actively screening stocks within the Nasdaq 100, the goal is to be more resilient than a pure index fund during market turbulence. At its current 10% yield, it occupies a very reasonable middle ground. However, as many of you know, I have always been an index investor at heart, so my personal preference is to trust passive index selection over the decisions of a fund manager. And looking at the data from 2025, while JEPQ did a decent job maintaining its net asset value, when compared to the index tracking QQCC, you will notice that JEPQ wasn't significantly more resilient during major pullbacks, and its overall performance still lagged behind. Over the past year, the total return with distributions reinvested of JEPQ was 10.53%, while QQCC reached 11.9%. This clearly demonstrates the inherent advantage of passive index selection. There is also a very practical detail I need to remind everyone about. If you are someone who relies on a fixed monthly payout to cover your expenses, JEPQ has one notable drawback. Its distributions are not consistent. Because it follows a fully active strategy, the amount it pays out depends on the premiums collected from the options market and the dividends received from the underlying stocks that month. When the market is volatile, the payout might be higher, but when things are calm and option premiums shrink, your distribution will likely decrease. This means your monthly paycheck will fluctuate. For those of you trying to manage a precise budget, you'll need to account for this and leave yourself a bit of a buffer. Now, let's take a look at another Nasdaq player, QQCL. The fund's current yield is holding at 14.92%, which is a very aggressive level of cash flow. Its primary feature is that it carries 25% leverage, meaning it uses 25% cash leverage. However, the cost is relatively high, with an MER of approximately 1.88%. Besides the 0.85% management fee, a large portion of that cost comes from the interest expenses of borrowing. Looking at the performance data for the past year, total return with distributions reinvested of QQCL was 13.13%. During the same period, QQC, which tracks the Nasdaq 100, returned 15.38%, meaning QQCL lagged behind by 2.25%. At first glance, QQCL's growth might not seem as impressive as ZWT. This is understandable because ZWT focuses on the top 30 pure tech giants, whereas QQCL tracks the entire Nasdaq 100, which includes consumer and healthcare sectors alongside tech. But despite the slightly lower growth, I actually prefer QQCL. While ZWT relies on the personal judgment of a fund manager, QQCL follows a passive index. The strength of an index lies in its self-cleansing mechanism. Poor performers are eventually removed, and the winners automatically receive higher weightings. For those of us seeking long-term passive income, this systematic approach is often more reliable and lower maintenance than active management. However, every coin has two sides, and there are two critical risks you must be prepared for. First is the magnification of risk through leverage. We have to be realistic. While covered call distributions provide a small cushion during minor pullbacks, they are just a drop in the bucket compared to a magnified 25% drop in a real market crash. This leverage only makes sense if you believe in the long-term upward trend of the market, but the Nasdaq is a high-risk asset, and investing in QQCL requires a strong stomach. The second risk is amplified currency exposure. Like ZWT, QQCL is unhedged. This is a bonus when the US dollar is strong, but at this current stage, a weakening dollar acts as a speed bump. When you hold USD-denominated assets while the dollar is losing value, the leverage doubles down on that currency loss, directly suppressing QQCL's overall price performance. Finally, looking at the payouts, QQCL has been very aggressive. Since its launch, the monthly distribution has grown from 0.25 to about 0.315 per share, increasing alongside its net asset value. For investors who prioritize immediate cash flow, this growth is certainly a welcome sight. Moving on from QQCL, let's look at a fund I've been leaning toward lately, QQQY by Evolve. This is a very interesting high-yield ETF. Let's start with its basic profile to give you the full picture. Its full name is the Evolve Nasdaq 100 Technology Enhanced Yield Index Fund. The current yield is holding at around 13.99%, with a steady monthly payout of approximately 0.32 Canadian dollars. In terms of cost, the MER is about 0.99%, which gives it a clear pricing advantage over the leveraged QQCL at 1.88%. A key feature here is that it is CAD hedged, which locks in the exchange rate and protects our returns from a weakening US dollar. The underlying logic is purely index-based, tracking the Nasdaq 100 Technology Index while stripping out all non-tech stocks. From a selection standpoint, QQQY follows an index logic similar to QQCL, but because it tracks the technology-specific index, it removes non-tech companies like Costco and Pepsi. While this does increase volatility, it offers much more explosive growth potential in a tech bull market. Looking at the performance for 2025, with distributions reinvested, QQQY delivered a total return of 24.14%. While it did underperform QQQT, which tracks the same index without selling covered calls, it still put up a very solid performance. More importantly, it outperformed ZWT in 2025, which is a highly impressive result. The core efficiency of QQQY lies in its covered call strategy. Although it covers about 50% of its holdings like QQCL does, the execution is fundamentally different. While QQCL writes calls against the entire index, QQQY writes them against individual stocks based on their specific volatility. Since individual stock volatility is always higher than index volatility, QQQY is able to collect much thicker premiums. Combined with the higher growth potential of pure tech, this is why the fund's total return consistently outperformed the hedged Nasdaq ETF, XQQ, even without using any leverage. Truth be told, I've been thinking lately that since QQQY can essentially be viewed as an amplified version of the Nasdaq 100, why take on the 25% leverage risk and currency pressure of QQCL when you can just buy QQQY? While it may not beat a non-covered call fund like QQQT over the very long term, it has no problem outperforming traditional hedged ETFs like XQQ in a tech-driven bull market. If you have made it this far, you are in for the most important part of today's video, which is my analysis of HTAE. HTAE is Harvest's technology-focused covered call ETF, and put simply, it is a 25% leveraged version of their HTA fund. Let's start with the fundamentals. The yield is currently around 11.07%, paid out monthly. The fee structure is particularly interesting. While the management fee is technically listed as 0%, it actually charges 0.85% through the underlying HTA fund. When you include the interest costs for the leverage, platforms like Blossom show an actual MER of 2.49%. It holds 20 of the world's top technology stocks. To be honest, the covered call strategy of HTAE was originally the one I admired most. It only covers 33% of the portfolio and sells out-of-the-money calls. Logically, with 25% leverage, this should be a perfect way to convert tech volatility into cash flow while keeping pace with the underlying growth. Since 67% of the stocks are uncovered, there should be plenty of room for capital appreciation. I want the dividends, of course, but I am not willing to give up the growth potential. Many of you remember my backtest of HHIS also from Harvest. When HHIS first came out, I saw strong similarities to HTAE. But in 2025, HHIS delivered a stunning performance, outperforming the Nasdaq with a total return of 25.18% with dividend reinvested. In contrast, during that same massive tech bull market, HTAE's performance was baffling. Its share price only rose 1.1%, and even with distributions reinvested, the total return was just 13.95%. This leads to a very awkward question. In a year where tech stocks were skyrocketing, why did a leveraged currency-hedged fund like HTAE deliver such a mediocre report card? Was it a problem with the underlying stocks? To find the truth, I conducted a thorough backtest. Since HTAE is actively managed, I simulated its holdings using quarterly reports, dividing the year into 4 segments from HTA1 to HTA4. I set the corresponding test periods as January to March, April to June, July to September, and October to December respectively. While this isn't 100% precise, it gives us a general picture. My results show that the underlying stocks in the portfolio actually returned 19.6% in 2025. Even accounting for some losses from options being called away, HTAE still underperformed its own underlying assets by more than 5%, even with 25% leverage applied. Interestingly, if the holdings from any of those 4 quarters had simply been left alone without any trading, the year-end return would have exceeded 20%. This raises serious doubts about the quality of HTAE's management. While we proved previously that HHIS successfully turns volatility into profit, HTAE was left far behind during one of the strongest bull markets in history. I don't want to speculate on whether Harvest deprioritized HTAE to promote their newer funds, but I will say this. A fund company's reputation isn't just about how successful your newest launch is. It is about whether you continue to manage and operate your existing funds with care for the long-term investors who have stayed with you. After discussing all 5 funds, let's wrap things up with a final verdict and some closing thoughts. In my view, if you are looking for the purest and most efficient tech-driven cash flow, and you don't want the headache of currency fluctuations, Evolve's QQQY is the absolute efficiency king. It cleverly uses high-tech concentration instead of borrowed leverage. Combined with its high-efficiency individual stock option strategy, it delivers a very substantial cash flow without forcing you to take on the added risk of debt. If you are the type of investor who believes in the self-healing power of indices and has a strong stomach for the roller coaster ride of 25% leverage, then QQCL is also a very solid option. Its yield of around 15% is certainly powerful in a bull market, but you must remember what I said. In a period of US dollar devaluation, that leverage will amplify your currency losses. You need to keep that in mind before diving in. For those who prefer the reputation of big institutions and are looking for psychological defense and absolute stability, BMO's ZWT and JP Morgan's JEPQ are decent choices. ZWT has proven what it means to be a high-quality asset. Its distributions consistently beat inflation, and its principal is self-evolving, making it a fund you can truly spend from with total peace of mind. As for JEPQ, for an individual investor, I personally think buying an unleveraged fund like QQCC might actually be the better move. As for HTAE, I will stand by my point. A fund company's credibility is measured not just by how popular their new launches are, but by how they treat the long-term investors who have stayed with them. Whether you choose to buy is entirely up to you, based on the data I have shared today. Ultimately, pursuing passive income isn't just about the monthly paycheck. It's about a sense of control over your life and your wealth. I hope these hardcore data comparisons help you see the truth in this complex Canadian tech ETF market. Only when we take responsibility for our own capital will the fund companies truly be responsible to us. If you found this backtest data and logic helpful, don't forget to like and subscribe, and I invite you to share your thoughts on your tech holdings in the comments. I'm Old Fish, and I'll see you in the next video.